Hey there, everyone. Happy Tuesday, May 20th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a kind of overcast but still beautiful Redmond, Washington. Hope you guys are all doing well wherever you are at. Today, we're going to talk about the markets. Again, kind of a similar day to what we've seen in the last couple sessions, sort of a choppy day, but with defensive sectors at the top of the list. This almost feels, I'll be honest with you, like one of those stealth correction kind of moves, right? One of those where it feels like there are signs of a downside rotation, even though the price of the S&P doesn't reflect it. And let me tell you what I mean, right? Sort of after a big rally, often you will have that sort of digestion phase, and you often have a bit of a pullback, which, to be honest, after the run we've had from early April to now late May, significant. And I think no one would disagree that a pullback at some point makes a ton of sense from a technical perspective, right? I mean, just from, the natural ebb and flow of market activity, right? You need those pullback waves, even if the long-term trend is still positive, if that's something you agree with. But this is one of those times where even though the level of the S&P is about the same over the last week, right? We've had this big run higher. Now we're kind of stalling out. You have a lot of the growth stocks not necessarily powering to new highs, right? You're getting little bit of a pullback in names like Broadcom, like I'll show you later in the show. You have defensive sectors at the top of the list, right? 8 out of the 11 S&P sectors were down today. So that isn't like a raging bear market, oh my gosh, end of the world kind of move. But it certainly suggests that whatever was happening, the juice that was driving this rally from early April to mid-May, maybe that's starting to change a little bit. And maybe we're at least getting some sort of rotation in terms of leadership. And while that doesn't guarantee a pullback necessarily or a huge corrective move, it tells you something's different. And when there's something different, that usually provides opportunities for investors that are savvy, mindful, as I would say, and willing to focus on things that are starting to emerge in a position of strength. With that in mind, let's get to the charts and focus on how things played out today. Kind of an interesting day all around, to be honest with you. A lot of red, to be honest with you, at the end of the day, with the S&P closing down 0.4% to 59.40. Now, it was down as much as 59.10, except for the last hour, which was kind of a nice bounce higher. And we often talk about that last sort of 30 minutes to 60 minutes as being a time when a lot of institutions are at work. So encouraging, I would say, of anything, the fact that yesterday's session on Monday, today's session here on Tuesday, you're getting a nice bounce in the last hour of trading. So that's not a bad thing, right? Could be a lot worse, right? We sell off over, below 5,900 into the close. Then I would be telling you, wow, this is a really negative day with all the bad evidence. Today, not as much, right? Today, at least you're getting a bounce into the close. Some buyers coming in the last hour. However, the general trend sort of weaker today. So S&P down about 0.4%, almost the same for the NASDAQ, closing around 19,142. Mid caps, small caps, all down, but small caps actually the best performer of that group, only down about 0.2%. But to be clear, pretty much everything was a little bit down today. The VIX essentially unchanged from yesterday. We're right around 18. So we're in the upper teens, which means still a low volatility environment. Anything below 20 is pretty okay volatility wise. Anything above 20 starts to be the sign of at least a pullback. Anything above 30 is a dangerous environment. And again, when the VIX goes above 30, that just tells me usually best to stay out of the way and wait for some sort of capitulation event or some, just be prepared for further downside potential. VIX, where it is right now, tells you not much to worry about yet in terms of the volatility as priced in from the S&P index options market. Looking at the fixed income markets, you can see the TLT was down. That's a bond ETF, a treasury ETF, finished down about 0.7%. It opened pretty weak and then just never really recovered in any meaningful way. And that was after rallying into the close yesterday on yesterday's session. So today, much weaker open and basically sort of limping into the close. Not a horrible day, down less than 1%, but certainly not up. Rates, particularly the longer end of the curve, went higher. So usually the curve moves together, particularly like 5 to 30-year points, kind of drifts up or down. Today was more of a steepening of the curve where the 5-year yield comes down, the long bond yield pushes up a little bit. So more of a normalizing of the yield curve. The dollar index, not a huge change, down slightly from yesterday. I don't think I grabbed a chart of the dollar, but I would keep an eye on that one for a potential bear flag pattern. We've had a bounce in the dollar, rotation lower, than sort of this upside bounce, and now potentially rolling down and breaking below that bear flag pattern. Something to keep an eye on. Looking at the commodity space, gold bouncing beautifully off an ascending 50-day moving average, up another 1.9% today. Silver prices, the SLV, up 2.4% today. Natural gas prices up pretty significantly, with the UNG, which is a natural gas ETF, up 8.5%. Crude oil, kind of the laggard of this group, but overall commodities had a pretty decent update. And look at the chart of the GLD, sort of gapped or opened higher for the first hour, and then just continue to accelerate in the afternoon to finish above 303. Pretty nice up move, and again bouncing off of support. Speaking of things bouncing higher, Bitcoin very, very close to pushing to new all-time highs. We're getting to 107. We get up to 108,000. We're pretty much there. It's been an incredible recovery on the chart of Bitcoin. I did grab that to talk about it briefly. It's a bullish chart, and Bitcoin looks stronger than others, right? Things like Solana, things like Ethereum, not bad charts, but certainly not in a position of strength like you're seeing with Bitcoin. Certainly appears to be emerging as the leader in the cryptocurrency space, at least from a technical perspective. Looking at the 11 S&P sectors, as I mentioned in the introduction, 8 out of the 11 finishing down. So that's only 3 positive. And it's not the offense, right? It's not growthy offense like technology. It's not value-oriented offense like industrials. Those are both kind of middle of the pack today. It's defensive sectors. Consumer staples up about 1/3%. Utilities, healthcare both up about 1/4%. Everything else was down today. Energy, the worst performer, down 0.9%. Financials, real estate, consumer discretionary, all down about 0.5%. So again, not a huge directional move day in a lot of places. Besides commodities, besides like Bitcoin, besides gold, commodity. I mentioned commodities, gold in particular, moving higher. Rest of the risk assets sort of choppy sideways on a session like today. But again, defense over offense, the theme as we're looking at the sectors. You can see by the way that the breadth is color-coded on the stock charts platform, not great. If you look at the S&P, 2 stocks down for every one that was up. Similar for mid caps, similar for small caps. The NASDAQ a little more balanced with slightly more advancers than decliners. But generally speaking, these are fairly negative breadth numbers. Not horrible 90% down days, but more bad than good. So this is what I'm talking about, right? When you have the rally that we've seen, the things that I look for would be deterioration in breadth, which tells you things are starting to break down, but not enough to really move the benchmarks yet. But things underneath the hood are getting worse. And we're seeing some negative breadth readings today and yesterday as well. Leadership rotation, right? So whatever was leading out of the lows stops leading and something else takes its place. And we're maybe starting to see that. I think it's a little too early to declare defensive sectors like consumer staples the big winners here. But I'm seeing a series of days where we're over the last couple sessions where the defensive sectors at the top of the leaderboard. That's a little something. The other thing to look for is just, breakdowns in price, right? Stocks failing to break to new highs, stocks breaking out and then failing to hold those breakout levels, stocks breaking support. And that's why I don't think you've seen a ton of that, but maybe, right? And I think those are the things we should be looking for here in the days and weeks to come for sure. All right, looking at the Magnificent Seven. I mean, Alphabet at the bottom of the list, down 1.5% today. Amazon, Apple, all down about 1%. 3 of these were up. Tesla up 0.5%. Tesla struggling at its 200-day moving average right now. Broadcom up 0.5% as well. I'm going to show you the chart of Broadcom in a little bit because we talked about a steep trend line off of those lows. It hasn't closed below it this week, but it has traded below it now yesterday and today's session. Netflix basically flat for the day, and everything else down. So this would be something that could be concerning if you see more of that. Stocks like Apple really haven't broken out in the way that names like Meta and Netflix have done. So I think the bull case from here means Apple and Alphabet and others really accelerate. Stocks like Tesla break above their 200-day and hold it. And you're starting to see some question marks with some of those trends that I just mentioned. All right, let's look at the market carpet, what we call a heat map style analysis. This is where we focus on the big picture. We talk about some general themes. We focus in on some individual names. I mean, not a great day heat map wise here. Not horrible. So you're not seeing a lot of bright red, which would imply stocks that are down a ton. So down 3% gives the brightest red on this particular visualization from stock charts. And I don't see a lot of that. You're seeing a couple random clusters around the board, but generally not a ton. It's just an underwhelming heat map, I would say, today. Things that stand out to me, and I'd encourage you to look at this visualization and comment on what stands out to you. I mean, the lack of upside on some of the leading growth names is what immediately stands out to me. NVIDIA down 0.9%, Apple down 0.9%, Alphabet, the worst performer here, down 1.5%, Meta down, Amazon down. So most of these leading growth names are lower, and so that's really what's causing the major benchmarks, the S&P and the Nasdaq, to stall out a bit. Those benchmarks are driven by those big mega cap growth stocks, and if those are struggling, there's just limited upside that you can have from the growth dominated benchmark. So the lack of upside follow through just this week so far is certainly something to focus on. Boy, talk about a lot of green in the healthcare sector. And this is another big change, right? Healthcare has been absolutely clobbered with names like UNH getting beaten down, biotech names, pharmaceutical names, a bunch of things struggling here. Today, sort of like the best sector, I would say, from a breadth perspective. I did grab the chart of Gilead, which is a biotech name to look at, breaking to a new swing high today. We can see Regeneron, which is maybe making a low. I didn't grab this chart, but I'll show it to you because I believe it's a pretty good bullish divergence, which is true, right? So we have lower lows April into May, higher momentum. So we're getting bullish momentum divergences on something like Regeneron, which has been a fairly rough stock year to date. UNH obviously has been an absolute disaster for so many reasons, which we've talked about, just exiting the oversold condition today. What's interesting about the chart of UNH this week, by the way, arguably here, if you look, you have a gap on the way down. You then have this other gap here. You'd probably call that an exhaustion gap. There are a couple different types of gaps. I did a show for Stock Charts TV yesterday, my weekly show, and we talked all about gaps. I'd encourage you to check that out if you missed it. We didn't talk about UNH in particular, but a big drop and then one more gap into a hammer candle, kind of a classic bottoming pattern. You call that an exhaustion gap, sort of like that one big move lower. And the fact that you've seen accumulation right after that gap is pretty encouraging. This is not the type of chart I would be personally touching for a little while, but if you're more of a bottom fisher, I get the argument in buying the strength off of those lows and coming out of those oversold conditions. Makes sense to me. What else can we say? I mean, consumer staples, one of the other defensive sectors, doing quite well. Dollar General pushing above $100 a share today. That's up another 4%. Dollar Tree breaking above $90 a share. Both of these stocks were pretty ugly at the beginning of this year, and really in the first quarter really hadn't emerged. But then in Q2, both of these have started to break out of their Q1 ranges, breaking above their highs from the fourth quarter of last year, starting to move further to the upside today. That's pretty encouraging. Some other red things to talk about: airlines, right? So UAL, Delta Airlines, not bad. These are pulling back after a pretty good run, but certainly something to watch. These have been pretty good gainers off of the early April lows. Within the consumer discretionary sector, some of the gambling names like Wynn rolling over after having a nice rally, kind of a mix of other random things, but gambling names in particular jumped out. LVS, MGM, Win, all in the red today. So not a big directional move. Again, a day like today really helps to identify those names that are the outliers, right? If the averages are kind of flat, if most stocks were kind of neutral, which are the ones that are really moving? Because that can tell you maybe there's something there. There's something that's not as much macro market related and more something else to think about. And sorry, I keep glancing out the window. This is a really fun time of year, to digress for a moment, in this area where you have these cottonwood trees that are all over this region here in the Pacific Northwest. They all bloom right around the same time. They all let go, and it all of a sudden it looks like this fairyland where for about a 2 to 3 week period it looks like it's snowing, and it's these cottonwood trees that I guess for good news, we have them all over our property. They're an absolute nuisance for about 2 weeks coming up here at the beginning of June, where they just drop a ton of big chunky cotton pieces, but it looks pretty. So that's why I keep getting distracted. Sorry for that. By the way, if you want to dig into some of the seasonality market-wise, we're doing a free webcast tomorrow on Wednesday, May 21st. I hope you will join me. It'll be an hour of your time, and if you can watch it live, please do so. If you can't watch it live, make sure you sign up, and I'll send out the replay as soon as it's done. We're going to dig into seasonality. It's called Sell in May 2025, Seasonal Strategy or Outdated Myth. We're going to do 3 things in this webcast tomorrow. Number 1, we'll talk about the traditional sell in May pattern, what sell in May and go in May really means, why it has become a thing so many traders kind of know and still believe in 2025. Number 2, we'll look at some of the recent history, and you'll see how the sell in May strategy has not been particularly helpful. We'll talk about why and some of the tools that can help you improve the success rate of that seasonal trend, which is still there, just in a bit of a different form. And then we'll look at some of the charts we will be focusing on here in the weeks and months to come to determine whether a seasonal sell-off that usually happens in the near future, whether that's actually going to come to pass. You can sign up at marketmisbehavior.com/May 2025. Scan the QR code that you see on your screen. You can sign up there. And again, if you can't make it live, no worries. Just make sure you sign up, and I'll make sure I send you the replay as soon as it is ready. Should be fun. All right, let's look at some charts. We'll take some questions. We'll call it an evening, shall we? The S&P daily chart gapping higher recently, as we've covered many times. The gap here, I think, is pretty crucial. We're eyeing that 57.25 to 57.75, we'll call it, range, which is basically the gap formed earlier this month. That gap also includes the 200-day moving average. I go with a line in the sand approach when I'm looking at a chart of the S&P. I assume that the chart at any point is guilty until proven innocent, or innocent until proven guilty. You sort of define the primary trend, you define that bias in the markets, and then you look for signs that you're wrong, right? You look for signs for that to change, and that's where the line in the sand comes in. I see this market as innocent until proven guilty, and I think below that shaded area would be proven guilty. So for now, my market trend model is bullish on all time frames. Market's going higher. We're stalling out a bit this week, which is something we'll continue to monitor. But for now, as long as we hold that shaded area, I think things are pretty encouraging. Worth noting, we just came out of the overbought region today. We were overbought at the end of last week and as well on Monday's session with the RSI right at 70. Today, pulling back a little bit. That all of a sudden makes this look like some previous pullbacks. Maybe not be an end of the world kind of pullback, but pretty reasonable given the run that we've had, given the overbought condition. That you have at least kind of a December 2024 type of pullback. You know, in an uptrend phase, you kind of look for a pullback to an ascending 50-day moving average. That's what we've seen on the price of gold, for example, in the last couple of weeks. I would say based on this configuration, a pullback to the 200-day would make a ton of sense. Even if you're all bulled up and you think this market makes new all-time highs in the month of June, a pullback arguably is the only way that's going to happen, because you can't keep going forever. At some point, things really start to roll over. So having a constructive pullback where you have a higher low with which you can start to form a broader advance probably makes the most sense on for the bulls as well. But for now, that's kind of where we're at. Coming out of the overbought region after the run, we're looking at 57.50 and a little space around there as a level to watch. Now, don't get too excited, because I am bringing up the Hindenburg Omen chart, but not to tell you that it's signal. It has not. So cool your jets. That's not where I'm at. But I just wanted to tell you, it is, what we would be looking for. This indicator and indicators like this, I mean, the technical toolkit is filled with, it's a very diverse toolkit with a lot of different things in there. And I would say in my work and in the course of our shows, we touch on a small part of that I found most helpful. And while some indicators like RSI or moving averages, I have on pretty much every chart I look at, something like the Hindenburg Omen is something that does not signal very frequently, right? For years on end, you won't get a signal. Like, for example, all of 2023 and most of 2024, it's just not a chart you need to look at. However, I found when it does signal, it tells you a particular set of circumstances are now lining up that look very similar to previous market tops. The last time we had a valid Hindenburg Omen sell signal was at the end of 2024, which I would consider a pretty decent sign telling you this bull market of 2024 was probably near its end. It was near its exhaustion point. That allowed us to look for divergences and other things that helped us prepare for that sudden downturn that we saw coming out of the February peak. Now, what's happened is the market has rallied enough off of the April lows to reinitiate the Hindenburg Omen. And the way you can tell that is the fact that the 50-day rate of change on the New York Stock Exchange Composite Index is back above the zero line. And there's no way, that's actually one of the components, is the market has to be in an uptrend as defined by this particular, this specific comparison. Where are we at versus 50 days ago? We're now back above the zero line, which means we could have a potential Hindenburg Omen signal. So the two other things we have not seen yet that we would need to see: number one, breadth rotating lower. So the McClellan oscillator going back below zero. It's currently above zero, and it has been since mid-April. The second thing would be an expansion in new highs and an expansion in new lows. You need at least 2.5%, 2.6% of the listings on the New York Stock Exchange making a new high, and that same amount making a new low on the same trading day. Now, we have plenty of names making a new 52-week high on a day like today. What we don't have are enough stocks making new 52-week lows. So those are the two things we would need to see that could reinitiate the Hindenburg Omen sell signal. That's sort of the next level of using indicators like this, is not just waiting passively, reactively for the signal to emerge, but sort of getting ahead of it and watching to think about what signals would tell you that there's a similar kind of topping pattern happen. So we'll continue to monitor that chart, but I just want to show you that given the rally we've seen off the April lows, it's actually enough for that indicator to reinitialize, which means we start monitoring that for another major topping signal. Again, not happening yet. Let's look briefly at some other asset classes. You can see the bond markets, as I mentioned, have been in a downtrend in the month of May. So rates have been going higher as bond prices have been going lower. I see this chart in a primary downtrend of lower highs and lower lows. The TLT is below two downward sloping moving averages. The RSI is really more neutral than anything, but it's generally speaking moving more toward the negative range, with the RSI breaking below 40 on these recent sell-offs. So what's interesting about the chart of the TLT is we are rapidly approaching 52-week lows. That's around 84. That's where we bottomed out in January of this year. It's also where we bottomed out in April of last year. So we'll keep an eye on that as a potential bottoming point. Could be a bit of a bounce off of that support level. Remains to be seen. But for now, rates going higher, prices of bonds going downwards. Gold having a bounce off of the lows. This is the GLD bouncing off of an ascending 50-day moving average. I was asked by one of my premium members about pullbacks and what a pullback looks like and what I tend to look for. And I said, general rule of thumb, you see a stock or an ETF in a primary uptrend and we pull back to an ascending 50-day moving average or a 10-week moving average. It's pretty much what the GLD has done from last week to this week. I'm liking the bounce off of the swing low here. I'm liking the fact that the RSI did not get below 40 on this pullback in the month of May. The stochastics indicator, which I don't use a ton, but I do occasionally look at, just registered a buy signal at the beginning of this week as we tested the 50-day and bounced off of it. So we're seeing a bit of a bounce higher, a tactical rally off of those lows. I would say gold still remains in a primary uptrend. I do own the GLD and the IAU in my own accounts, full disclosure. Crude oil prices, just to let you know, some really good interviews on the Market Misbehavior podcast. Last week, I had Nick Raish of the Earnings Scout. I also had Gary Antonacci, who I consider a mentor in the world of momentum investing, and fantastic, super nice guy, Gary, who's had some great experiences in the financial industry, working with some incredibly successful traders. The interview was awesome. It was a lot of fun. And we talked all about dual momentum investing, which was his methodology that he has popularized, and a bunch of other things. The reason why I'm going through this is because this is the chart of crude oil. And I interviewed Jesse Felder just a couple hours ago for the latest episode. That should be out to you tomorrow morning, most likely. But we talked about crude oil. He was actually bullish on energy, bearish on gold. I'll leave it to Jesse to share why and the long-term charts that fuel that particular point of view. Also some growth names that we looked at, among a lot of other things as well. But some great words of investing wisdom and specific ideas about positioning here in Q2. So look for that episode here very soon with Jesse Felder on the Market Misbehavior podcast. I would say from a technical perspective, if you look at the chart of crude oil for the last year or two, we have often had these bounces. They've usually stalled out around 50 to 61.8% of the previous rally. We most recently saw that here in early April when we retraced about 50% of the previous decline. We retraced about 50% of the way up to 64 about a week ago before pulling back here. If we continue higher, 66 is sort of that last line in the sand. If you don't get resistance there, then it really suggests that breakout in gold that Jesse and I talked about on the podcast maybe really starts to emerge. So oil potentially making a double bottoming pattern here, breaking above that swing high from April would be pretty important way to validate that. Bitcoin is right there at previous all-time highs. We're currently trading just below 107,000. There are your all-time highs around 108,000 and change from December of last year, and also echoed in January of this year, which created a beautiful double topping pattern. If you take the height of that pattern from the highs to the swing lows, project that from the breakdown, it gives you a perfect downside objective, which lined up essentially with the April low. Then we rotate back above the swing highs. We continue to the upside, and now we're back up to those previous highs. So from a technical perspective, pushing above and making new all-time highs would validate a new uptrend phase. The history of Bitcoin has been a story of hitting those previous resistance levels, eventually powering through. And that's when some significant gains have happened. In the short term, I'm watching this potential bearish momentum divergence, something to watch as we rally on a bit of a weaker momentum reading. So something to pay attention to as we test all-time highs. All right, a couple more charts. Here's the chart of Broadcom, AVGO. We've shown this chart here recently, particularly this trendline support from the low in early April, mid-April. That lines up pretty well with lows in the next couple weeks, and that lines up pretty well with where we're at this week. Now, the last couple sessions, yesterday on Monday and today on Tuesday, we opened weaker and closed higher. So on a tactical time frame, that's actually pretty encouraging. We have lower opens, but buyers are coming in, but it is potentially taking us below that trendline support. Not the end of the world if that happens, but certainly tells you that whatever was happening here may be starting to change a little bit. So the bear case would be a breakdown below trendline support, RSI coming out of the overbought region, maybe a divergence of sorts if we continue higher a bit, but something to watch on Broadcom. Again, almost making it back to their all-time highs from January. Palantir. Now, this is the bear case. I mean, the bear case from here, I'll lay it out very simply. Stocks stop going up, and I say that with a bit of sarcasm, but also I'm serious. If you look at the chart of Palantir, it has been an incredible recovery. This looks like this very gentle cup and handle kind of pattern, and it is, but these are huge price swings from 125 down to 68, all the way back to 125, pushing higher to almost 135. And these are big percentage moves that create this pattern. And the breakout above resistance is super meaningful. And that's what we had about a week ago when Palantir finally broke above 125. But what's happening is we've stopped going up. And since that breakout day, we've basically stalled out a little bit. It's not the end of the world. It's not breaking down yet. But what I'm seeing is new all-time highs on weaker momentum. That's a bearish momentum divergence. So I think the bear case on Palantir, we break back below this pivot point at 125. Worst case scenario, we break below the lower end of the handle around 105, and that would be a pretty negative development. But bearish momentum, making new highs on weaker momentum, is usually not the makings of a great bull market phase. That's usually a questionable breakout that you often want to fade more than anything. So what's working if stocks like Palantir are stalling out a little bit? Besides things like gold, Newmont mining, popping higher today, Gilead, right? GILD, as I mentioned, the healthcare sector filled with a lot of names working out. GILD broke above its 50-day moving average today, broke above the swing highs from late April today, closing the day above 109. I like the fact that we consolidated. Look at the pullback to the Fibonacci level here. So this is the May low. That's the March high. 38.2% of the way down is 96.50 or so. That's the bottom that we experienced in April and May, and now we're rotating back toward the upside. Pretty constructive overall technical structure there, and the short-term breakout above the 50-day could be a sign that there's further upside to be had. All right, that's the market update. Those are some charts that I'm looking at, and let's look at some questions here. Where else are we going to go? Let's see. I saw a number of random questions in here. Do do do. Richard, thanks for watching on YouTube. Dave, do you use time cycles in conjunction with the Hindenburg Omen to help forecast its next appearance? I mean, the short answer is I really don't a ton. There are, and again, I mentioned how diverse the technical toolkit is. The problem is there are 8 kajillion charts or indicators you could look at any given time, and you can't look at all of it. So what do? I found you have a core set of indicators and techniques that you look at. Then you have other things that are more anecdotal for you that more help you round out the picture. For me, I have found focus on the charts and techniques that I think are most valuable. Talk often with traders and strategists and money managers who use very different toolkits. So I'm not a big Elliott Wave guy, but I love talking with people who use Elliott Wave as their primary investment tool. Whether or not I always agree with them, it stretches my thinking. It gets me out of my comfort zone, out of my little blinders on echo chamber of my own charts. Same with GAN and other sort of cycle related tools. Every time I talk with Larry Williams, we end up talking about cycles because he's big into the cyclicality of markets and things like that. It's just not a big part of my toolkit. The only big cycle related thing that I pay attention to is seasonality. That's why I'm doing the webcast tomorrow on the sell in May phenomenon. I think that's an interesting topic that I think is a rich opportunity to explore different evidence and think about what tends to happen, the tendencies, the cyclical patterns, but what's actually happening right now. So with the Hindenburg Omen, no, I don't do a lot of seasonality, cyclicality to say when should I expect a Hindenburg Omen to fire because of a normal cyclical pattern. But I will tell you, having looked at cycle analysis in the past, having talked to a lot of people that are big into cycles like Larry Williams, like Sherman McClellan and others, I definitely respect that. And I love, and I find a lot of value in talking to people like that about what they're seeing. I'm making a note to reach out to at least one of those guys and see where they're at in terms of cycles right about now. And I'll pass on any insights that I can share with you. But for me, the Hindenburg Omen is more about looking for a certain set of conditions when they emerge. That's the signal, and that's what I'd be looking primarily for. Average Joe, don't undersell yourself, my friend. Is Rivian in an uptrend officially with the lower high? I haven't looked at Rivian in a while. I'll be totally honest with you. So the question was, is an uptrend officially with the lower high? I'm not sure what you mean by the lower high, but I would say it's a pretty impressive recovery. I mean, the fact that Rivian looks how it does after this business in Q1, I mean, the end of the first quarter, it's looking pretty vulnerable. And we had this downtrend, trend line you can track here. We've broken above all of that. We've broken above the 200-day. I'm not going to tell you the golden cross is the most important signal you're ever going to see because the last one was there, which is pretty much the peak. So that may be a bit of a concern, the fact that it's happening today. But I would say the fact that it's breaking out, the pullback to the 200-day, that's all good. The chart of Rivian now is vulnerable because it's overbought as we test a previous resistance level. And you just look to the left on the chart, you can see a bunch of times where we become overbought, and that's sort of the end of that tactical rally before rotation lower. So overall, nice uptrend. I would say this trend is higher. So as a trend follower, looks pretty encouraging. I think getting above that January peak and staying above there will be the most encouraging sign. When I find something overbought, testing a previous peak where it rallied to an overbought condition, a lot of these have had some bearish divergences. So I might be looking for that right about now. I probably wouldn't be chasing this at this particular moment. Wait for some sort of pullback, right? When you see a chart like this that starts to improve higher high, I see what you're saying. Yeah. I mean, so I think that's encouraging. I think now, as long as it holds it, that's good. What you have to remember is in terms of the multiple timeframes, right? This tells me like medium term, this is starting to improve, but I would need to see a valid breakout above this resistance. And looking to the left on the chart, I'm seeing similar conditions to previous tradable peaks. I'd probably be looking for a pullback as an opportunity to take a position on something like this if I'm not already owning it. But for now, impressive run and going from 1050 to 17 in about 6 weeks. Not a bad run on a percentage basis. It doesn't look like much. It's a lot. Folks, thanks so much for joining me here on the show. As always, thanks for joining live and asking some great questions. I got to some of them, but not all of them. So the questions we didn't get to, we'll put in the mailbag. We'll do an all mailbag episode on Friday. If you're watching this on the replay on our YouTube channel, just drop a comment with your question. We'll take all those questions and answer some really good ones on Friday's show. Don't forget to sign up for tomorrow's webcast. Go to marketmisbehavior.com/May 2025 to sign up. And I will see you there. In the meantime, have a great evening. And remember, it's always a good time to own good charts. Have a good night, folks.